Just a few days left in February. This month is on track for the largest monthly gain in bond ETF inflows ever. U.S. bond ETFs have taken nearly $16 billion in through February 21st. Will these inflows continue, and what bond ETF is your safest for your money?
Joining us now is ETFtrends.com editor Tom Lydon. Tom, good to see you. We by the way, just had a Wall Street Journal reporting talking about the implosion at PIMCO, and one of the funds you mentioned, not the only one, but one of the funds you mentioned is administered by PIMCO. Isn't there a risk that as you should not be getting in just as the bond market is imploding?
Well, the bond market's not really imploding, and I don't think PIMCO's imploding. I mean, let's just say this. Bill Gross is a very competitive guy. I know him, I've met with him personally, and I know he has ticker symbols of other competing ETFs right on his screen. So he's very enthusiastic about what he does. I don't know about the inside baseball that your last guest talked about, but I wouldn't run away from PIMCO anytime soon. They are fabulous managers with a very deep bench.
Okay.
The herd, Tom, is notoriously late. And when we see that they're all rushing into bond funds, that scares me. And we do want to advise our investor viewers in the best way possible. You don't want to paint every bond fund with the same brush. I mean, there are convertibles, there are all kinds of things that you can participate in. But what's wrong? What's right? What will get you yield?
Well, that's it, Liz. And after 30% in equities last year and a big correction in January, a lot of investors took risk off, went into bonds. ETFs are the place that they went because there's so many choices. You can go from treasuries and munis, corporates, high yields, and across the pond there are plenty of choices as well. But with that in mind, there are some risks involved, as you point out. Just because the Fed and Yellen seem to be in a fairly easy monetary mode right now, that doesn't mean that yields can't go up. And when yields go up, the value of the underlying bonds go down in value. So one key thing is keep duration short.
Okay. All right.
As long as you're duration short, that's key.
All of those that you recommend, we want to get to your picks quickly here, are these short maturity bonds. The PIMCO we talked about, that's M-I-N-T. Let's talk about Guggenheim's Enhanced Short Duration ETF. What does that mean, Enhanced Short Duration?
Yeah. Well, the idea is on both these, both on Mint and GSY, they're actively managed. So the duration is short, less than a year on both. But yields compared to money market funds are tremendous. So you've got a guy like Bill Gross and the folks over at Guggenheim who are doing a good job mixing in higher yielding bonds that have a short duration that can produce these yields. And then finally, the advisor shares Paradis High Yield ETF, also actively managed, and if you look at that yield, over 7.5% yield for a duration that's a little over 2.5 years, pretty favorable, and it got a Morningstar 5-star rating too. So active management and ETFs are really coming into favor.
Tom, you're always in favor with us. Thanks for being with us.
You give us good advice.
Thanks, Dave.
Tom Lydon.
We're going to put all of Tom's picks because he has more up on our Facebook page, so definitely check that out.